On the podcast this week, with the new tax year fast approaching, we tell you how to take the most efficient salary as a director from your business. Welcome to the Profit Cash Growth Podcast. This is the podcast for 6 and 7 figure business owners who are looking to grow a financially successful business. My co-host, Claire Hancott, is a finance director, chartered accountant and entrepreneur. And every week, I'll be exploring guidance and frameworks designed to help you increase your profits, improve your cash flow and grow your business. So we're recording the podcast a little earlier than usual, aren't we, this week, Claire? And in two ways, like it's 8 a.m, which is...
It's quite early.
Yeah,
I did just have to say to you, do my eyes look open yet?
I'm not an early bird, but also a little bit ahead of its release date, because I'm about to get a rare bit of peace, aren't I? What's about to happen?
Well, that wasn't very nice, wasn't it?
No.
I'm having a little operation, so I'm going to be out of action for a few days.
You're going to be out of action
Yeah.
in your mouth area, aren't you?
Yes. Got to have just a wisdom tooth out, but as with everything, it's never that straightforward, and there'll be a hole between my mouth and my eye socket, essentially. So a bit of reconstructive surgery going on as well. So,
But for me, the exciting thing is you're not sure if you're going to be able to talk for a week, so...
yeah.
We're going to have to record this in advance so that our lovely listeners can get our usual juicy tidbits for the week.
Yes, so we are up bright and early. Apologies if we don't quite yet sound awake. We've been awake for a little while, but just for some reason, the juices just take a while to kick in the morning, don't they? And everything just feels a bit slow and a bit sleepy. So
I'm going to have another sip of my coffee and then we're going to crack on with News Story Week, all right? So, this week's news story of the week. Fewer job cuts despite budget fears. Confused, to say the least. So, there are news stories everywhere about how much the budget is affecting job losses, redundancies and various other things. This story that's come out today is from figures from the Insolvency Service that suggests the number of redundancies in the 4 months since November, so that's November, December, January, February, is down on the same period 12 months earlier. So to give you a bit of an idea, Claire, of the sort of size that they're saying, in that period there was roughly 96,000 job redundancies. In the year prior, 113,000. So
we're talking like 2024 was the lower number, 2023 was the higher number.
Correct. So,
Okay.
so less than expected, which actually contradicts lots and lots of news stories we hear, or anecdotal evidence from businesses that keeps coming out about the amount of redundancies that they are making. And in addition to this, because we've got a few different news stories, I know you're going to throw a contradictory one in there as well, is Wes Streeting came out yesterday saying he's going to be cutting 7,000 jobs from central NHS. So even the government themselves are making announcements about their redundancies. So what's going on here, Claire? Is this just a case of it's too early to tell, and business owners, as we know, aren't usually super hot with their numbers? So maybe the big boys are out with their strategies, but the small businesses will follow when they realise the pain post-April? Or do you think there's something else going on here?
Well, I think there's probably a big difference between sentiment, because interestingly, LinkedIn released a news story on exactly the same day, and it was that employees have never been more fearful of losing their jobs. I think it's roughly about 45% of employees are worried about job cuts.
Oh, that's an
so
interesting
that's
story.
a huge statistic.
Yeah.
And that's up from around, I think it was about 30% it's increased by. But interestingly, they had 4 different graphs on there, and it was whether you're going to lose your job or not. It was the cost of living, which is declining rapidly. Apparently, the fear around the cost of living is declining rapidly, even though the cost of living has never been more expensive than it is now.
But the sentiment of it's disappearing into the back. Yeah.
The other thing that people were really worried about was housing.
Yeah.
But people are not worried about the economy anymore. So I feel like what people are worried about is massively driven by what's in the media. And that they don't really understand what's happening.
Yeah.
But there's also another thing around big companies, and ultimately most of the redundancies will come from really huge organisations. One or two people in small businesses around the UK isn't going to really be a dot in the ocean compared to what happens in large employers. And, you know, these large employers where you've got like 1,000+ people in your workforce, it's not unusual to have over 100 job vacancies advertised at any one time.
Yeah.
You have this constant churn of employees and constant temporary headcount to plug gaps and things like that. And it's that will stop, because actually for a big employer to make people redundant, it's incredibly difficult. It's very legislative. You have to go through this long consultation process with your employees, and it's just, to be honest, it's a pain in the arse. You could literally just wait for people to hand their notice in naturally. You don't have to make this big announcement. You don't have to do anything which could potentially attract some negative media for your organisation. You just wait for people to hand their notice and you don't replace them.
Yeah. It's a big strategy in big business. I used to know, you used to know it as well.
It was the first lever that we would pull as an FD.
Natural attrition.
Yeah, it's just that natural attrition rate is if our numbers were starting to slow, we were a bit worried about profitability, it was the first thing we would do is we would just put the brakes on recruitment. We wouldn't get rid of people because there's a cost to getting rid of people that often is more than the time, the money saving in the year that you'd make from making that person redundant because of how high some of the redundancy figures were. So we'd just pull the brakes on recruitment, and that would be the number one lever that we would pretty much pull every time numbers got a bit tight.
And it's all right saying that, it's an inevitability of the price increases in the budget, tax increases in the budget, but I'm not feeling anywhere near like I would need to, lay off staff in my business. And, you're not in your business, you're in a growing business. And what are you seeing across... Oh, Claire's having a little choke. Are you all right there?
I was trying to do that so quietly. I've been choking for about 10 seconds in the background there.
So, what are you seeing with other businesses and your clients? Are they particularly cutting, or, are like... as far as I can see, like I say, because the economy seems pretty stable, actually there's opportunities out there and your business is stable. I haven't got the ability to remove staff from my business because we need them to service the client. So therefore, the only way of dealing with it is by dealing with your price points. And I just wonder if that's going to be the way it's going to be dealt with more so than redundancies.
Yeah, I think in like small business, you tend to make very targeted hires, don't you? So that, for example, you've got a customer coming on board, or you want to like bring in your marketing or bring in your finance or something like that. So you make very targeted recruitment, and therefore I do think that small businesses will continue to recruit at a very similar rate to what they are doing now, because they want to continue to grow and they want to continue to push forward. So they will continue with those targeted heads. What we won't see in big businesses is the likes of Amazon just putting job adverts out for literally like 10,000 new warehouse employees. I think that will be what we'll see change. So for small businesses, I don't think there'll be that much change, other than I am quite excited because we're near Milton Keynes and 4 of the biggest accountancy firms are based in Milton Keynes. We've also got Xero head office in Milton Keynes. So it's incredibly difficult to recruit accountants. Now I'm thinking, surely some of these firms are going to start laying people off because these are big guys. They'll start laying people off. There'll be this swathe of accountants and bookkeepers flood into the market and all into the profit cash growth office. It will be magic for me.
I'm not so sure I'm going to see that, but anyway, good. Well, I think just to wrap it up as well, I think it's also an interesting comparison because they're comparing it to 2023, and I don't know about the broader economy, but certainly in my business, 2023 was an awful year, an absolute awful year. I mean, it was the start of Liz Truss and big interest rates and everything. I just think the economy was in a terrible place anyway. So I think there's probably more chance of people laying people off during that period anyway, even compared to now. So actually, I think the test case is interesting as well. So
yeah, I mean, not that we need to deep dive into it now, but who knows what's going to happen with America, because obviously we've just seen over the last few days the stock market, I mean, I use the word crash loosely, but 3% is quite a big drop. So yeah, let's see what happens in the next, what is it, he's been in 50 days or something, so God knows what's going to happen.
So on top of a mountain that, we're waiting for anything to happen with that. It just feels like it never ends. Anyway, should we give people some real value this week? Because I think everybody, including me, is waiting to hear, Claire, what they should be paying themselves from this every year. It feels like it changes. And I just want to know what the most tax efficient way of paying my salary is. Let's move on to this week's deep dive.
So I think if I had £1 for every time somebody had asked me this question, I wouldn't need to run a business anymore.
You'd have a tenner from me.
Yeah. There's a lot of confusion amongst directors about what their salary should be from April when there's all these national insurance changes and limit changes and things like that. So we're going to break it down for you. We're going to explain sort of what goes into the calculation and then tell you what we're suggesting the average director's salary should be for the coming tax year. So that would be starting in April 25, running to March 26.
Obviously, it is only our suggestion. You should get your own tax advice on how to draw your best salary.
Yeah. So what we're going to give you is the calculation for like the average person with normal thresholds and earnings and things like that. So it could change based on your circumstances. So we'll give you an idea of what you need to consider, but you do need to go away and ask your accountant directly about it. Don't take professional advice from this podcast.
Don't forget as well that Rachel Rees is having a not budget in March as well, so you never know.
Yes, this could
there
all
might
change.
Be something else.
This could all change, so we could be doing this again. Yeah, so here goes. So So, Simon, what would you like to know?
Well, I want to know exactly what I've got to pay myself. So, base salary first of all. So, what should I be paying myself as the base salary?
So, normally Simon doesn't script the podcast, but he puts down the notes, and then I have to go through and have some questions that Simon's going to prompt on, so we can sort of naturally segue from one topic to the next. But that hasn't worked at all. Simon's just gone in with a big question instead of the question, which is, could you give us a recap, Claire, of the changes that are coming in from April 25? Yes, Simon, no problem. Let's do that first. So, April 25 changes that would affect what salary a director pays themselves is obviously the big one is that employers' national insurance is going up to 15%. We've got the employment allowance increasing to 10.5k from 5k. And the employment allowance is essentially, it's the national insurance that the employers don't have to pay. So your first amount of employers' national insurance up to 10.5k is free for small businesses. And then finally, we've got the secondary threshold, which is changing as well. And that's when employers start paying national insurance. And that's been lowered from £9,100 down to a meagre £5,000.
Now, you said that with these changes in NI, if you're a really small business, you reckoned like 3 employees or something, then it didn't affect you at all, didn't it, when we covered this off?
Yeah, we did the calculations, didn't we? And I think it's roughly up to about, I think we got up to about 100k of salaries spread across multiple employees. If you got to around about 100k, then actually in a year, then actually you would probably be better off. But if you had more than 100k, you'd probably be slightly worse off. But even still, I mean, we're talking like a 1.2% increase. So for small businesses, you know, we're talking hundreds, maybe a few thousand, worst case scenario in most instances.
Okay.
So I think often the biggest confusion for a lot of even accountants, to be honest with you, is the terminology and the amount of thresholds. So there's really like 3 sort of thresholds that as a business owner you need to be aware of. And the first one is called the lower earning limit. Okay, so these 3 thresholds relate to national insurance. The first one is the lower earning limit.
This is the one that I'm like most interested in, because what I really care about as a business owner is I'm paying myself enough to do the minimum national insurance for state pension contributions. So that's what this limit is it? Exactly.
And that's what this limit is. So the lower earning limit means that you get the qualifying years towards your state pension. And particularly at the moment, there's been a lot of stuff in the news because if you don't have the right amount of qualifying years, then you can basically make a one-time payment and buy that qualifying year back.
Yeah.
Now, there's a lot of stuff happening in the news at the moment because there's some deadlines and things like that. So we're not going to talk about that today. If you're interested in that, go and check out Martin Lewis. I think he explains that all really, really well. But this is really crucial because obviously you want your entitlement to your state pension when you come to retire. So make sure that as an absolute minimum as a director, my recommendation is that you're paying yourself $6,500 a year. So $6,500, because that is the minimum earnings that you've got to have to get those pension contributions.
So how much is that a month?
Oh, well, it's going to
be... I knew you were going to answer that.
It's going to be roughly £550 a month, isn't it?
$540,
yeah. Now, the second limit that you need to be aware of is the primary threshold. Okay. And this is the level at which your employees' national insurance kicks in. Okay. So you pay employees' national insurance at 8%.
Employers or
employees. So as the employee, you pay tax at 20 or 40% plus national insurance.
So as a director, once you go above this salary, you're starting to pay national insurance. So this is the you want to be paying yourself more than 6,500, but you don't want to be paying yourself more than 12,570.
Not in all circumstances, but so don't get ahead of yourself just yet. Now, the nice easy thing is, for the first time ever, they've aligned the primary threshold and the tax-free allowance of 12,570. So those 2 numbers are now the same. So you don't pay tax and you don't pay national insurance until you earn £12,570.
Okay.
And that's really easy because previously those numbers have been completely different.
Yeah, it was like 9,000 versus it was really annoying.
So it was really annoyingly close, but it just meant that calculation, trying to explain that to people, was quite frustrating. So the primary threshold essentially is now the personal allowance, and if you earn under the personal allowance, you don't pay any tax and national insurance as an individual. Okay?
Brilliant.
And then the third threshold that you need to be aware of is the secondary threshold. And this is the rate that employers' national insurance kicks in. So at the moment it's 13.8%, but it's going up to 15% in April. And there's a big change in the secondary threshold because at the moment, I think it's like 9,700 and something, but it's kicking in at £5,000.
That's been reduced right down, isn't it?
It's been reduced right down. So that's why these big changes in these numbers make it quite complicated to say this is what you should be paying yourself through your business.
Oh, yeah, this is a nightmare because if you've already used up your allowance with your staff, you probably then don't want to pay
your employment allowance of the 10.5k.
Yeah, if you've used your employment allowance up on your staff's payroll, you then probably don't want to pay yourself more than £5,000 in salary because you're then paying 15% in employers' national insurance on it. I haven't even thought about this. Yes. This is nightmare, isn't it?
Exactly. And also with the change in corporation tax rates as well, where you can pay something tapered between 19% to 25%, depending on what your profits are, all of this then goes into the mix, and it could be quite a complicated calculation.
So you could get really caught out here because I was thinking I'm going to raise the amount of money that I pay because I probably pay about 9,800 quid a month or whatever. So I want to raise it to the 12,570 because to pay up to the tax-free allowance now. But actually, I'm using up all my employer's allowance. So what I want to do is I want to reduce my salary massively down to like 400 something quid.
Well, that's the instinct that everybody's got, that they're saying, I need to reduce my salary down to the £5,000 so that employers' national insurance doesn't kick in. But actually, no. So we've got some calculations here. Now, the employment allowance, which is the £10,500 that you don't pay any employer's national insurance on, that only applies if you have more than one employee in the business, basically. So if you're a sole director business, so you're the only person working in the business, that doesn't apply. But if you have more than one director or more than one employee earning over the lower limit, then you're fine. You can claim the employment allowance. This could be most of our audience. They've got employees in their business.
Yeah, absolutely.
Our calculations assume that the employment allowance applies. But what we've really got to compare here is what would be the difference if you paid corporation tax on the profit and then dividend tax. When you took the money out of the business versus if you paid employers' national insurance, employees' national insurance and personal tax, PAYE tax. So we've got to add all those three up. Now, if you look at any salary up to the limit of 12,570, which is your personal allowance, then actually the 15% employers' national insurance is less than the 19% best case scenario corporation tax that you're going to pay. So in all instances, the calculation works out better to pay yourself up to the personal allowance.
What if you're at 25% corporation tax, which a lot of our listeners will be?
Well, even more so, because 15% employers' national insurance is less than corporation tax rate. So therefore, it always works out better to pay yourself.
Okay, I've got you,
at that rate. Because there's no personal national insurance and there's no personal tax.
Fine.
Now, when you go over 12,570, this is where you absolutely need to have a personal calculation. Because in some instances, if you're paying 25% corporation tax rate, but you haven't utilised the full employment allowance, it could be more beneficial for you to pay yourself through salary rather than dividends.
Right, okay.
And this is where that calculation gets really, really complicated.
So you'd go down this route if you're a really small business and you don't have that many employees and not using all of your employment allowance. Delve deeper into this. If you're a large business and you know you've used your employment allowance on your staff, then it's likely to be option one.
Yes. So every director, put yourself on a minimum salary of 12,570. That's quite simple.
Okay.
Regardless of your circumstances, that would be what we're suggesting that you do. And then when you go over that, you can pretty much apply a simple rule. What we've got to think of is what's the difference between dividend tax and PAYE taxes? Even forget employers' national insurance for now. Now, if you pay yourself dividend tax, you're essentially paying corporation tax plus dividend tax. So we've got let's call it 20% corporation tax just to keep the maths easy. Plus 8% dividend tax, you're paying 28% tax. Now, if you pay yourself through salary, you're going to be paying 20% PAYE plus 8% national insurance. So roughly those calculations are going to be the same. So it's not going to be vastly different if you've got a salary under 50k.
Okay, which is unlikely for a lot of our listeners.
Yeah. Oh, well, I'd like to think that most of our listeners are probably earning more than 50k a year, and then in which case we are into dividend realm, really. Yeah.
Okay. Mind blowing, really, isn't it?
And for so early in the morning as well. I can see the cogs turning in your head.
I think what I'm thinking is that you've shown I've got the table in front of me, and people haven't got that on this podcast, and I think you need this laid out in front of you. What's the best way of getting this to people or giving people access to this or something that helps them calculate this or see it in one place.
If they just drop an email to marketing@profitcashgrowth.com,
we can just send them this it's just it really just shows you 4 different things, and it's got crosses and ticks in the box. It's really great what you've done here, but it helps me really understand the options in front of me here, Claire, which frankly have just been a minefield to understand when you're speaking to me, which I'm sure everyone feels the same. And it just shouldn't be I'm going back to this, it shouldn't be this hard for me as a business owner to work out how to pay myself.
No, but
it's insane.
This is like why you need to speak to your accountant about it. And a lot of bookkeepers will come at this. I've seen so many blogs online. Obviously we read like all the big finance newspapers and magazines and things like that. And I've seen so many blogs online in particular social media groups. What you get is one accountant or bookkeeper in that group post something that isn't quite accurate. And then before you know it, all of the lesser qualified bookkeepers, people like that in the group, take this and then go and give it to their clients and say, this is what you should be paying yourself. And so many people are assuming it's the lower, get your earnings under 5k a year.
Yeah, they're just getting the wrong advice.
Or at best, go for the 6,500 so that you get the qualifying pensions.
Or apart from anything else, that it should be a personal conversation for everyone. Everybody has different personal tax situations, and they should be having an individual conversation about what that looks like.
Where it gets really complicated is then when you start to look across group companies. If you've got a group of companies, the employment allowance can only apply to one of them, or it can be split across all of them. So then actually most of our clients where they've got group companies and or earnings outside of their business, this is when, unfortunately we can't do a tick box exercise for you and say this is what you should be paying yourself. So it really is a simple thing of make sure you're on the 12,570 going through your business as salary, and then above that it really needs to be probably a calculation at year end when you understand the rate of corporation tax that you're paying for the year. Then you can work out the most tax efficient way to extract the profits that you want from your business. That might be a combination of salary and or dividends.
Amazing. Great. So if you want this table that I'm looking at, which is really, really helpful, just drop me an email at marketing@profitcashgrowth.com. That's marketing@profitcashgrowth.com. And I will whiz it back to you. And shall we move on to Profit Cash Growth Extra, Claire?
Let's do that.
Let's do it.
So Simon wanted this to be like a deep dive, but I did say I haven't got that much to say about this. But so the government announced this week about electric car chargers. And for those of you who have got the gas guzzling Range Rovers, please bear with us, don't switch off. But if you do have an electric car and you want an electric car charger, the government has extended the grants available for businesses to install electric car chargers at your workplace. So you can get up to £350 of a grant towards each car charger, and you can do that for up to 40 car chargers. So that's brilliant because it means you can put multiple in. It was due to end this March 2025, but they've extended it until March 2026. So if you're thinking about getting an electric car, or you believe that electric cars are going to be a thing for the future, just get them installed in your office now, because you're eventually going to have to do it. I can absolutely see a time where government will mandate in the future, distant future, that all employers must make electric car chargers available or something like that. So
I think, look, if there's mass adoption, then employers will just have to do it, because it'll just be a sensible thing to do. How much does it cost to put an electric car charger in? I know the answer to this.
Well, it ranges depending on what you get.
Probably about £800 to £1,000.
Yeah, but
like that.
Saying that, it depends on the infrastructure. So
yeah, of course. Oh yeah, I mean, if it's super, super fast. I mean, I'm just talking about home level charges, 7 kilowatt delivery.
Home level charges. But I mean, if you're going for, you can go and get like commercial chargers like PodPoint do.
They cost a fortune.
Like office installations and things like that, which means that you can make sure it's easy to charge your employees back for electric charging, and or if a member of the public comes to can get into your car park, because that's the other thing to consider. If you've got an electric car charger and you've got an office that's unmanned in the evening, could a member of the public park in your car park and charge their car for free? So
I guess, wouldn't they have some sort of pass on them or some PIN number or something you give to employees?
Not as standard. If you think the chargers on the side of your home, typically just plug into your car. So you do need to consider that.
That locks it down.
But the reason why I'm telling you about this is because the best bit is that you can, if you work from home, and your home address is deemed a place of business, then you can get this grant to apply for your home. So there are 2 criteria. You must meet one of these in order for it to apply to your home. You must either have your registered office as your home address. And so you've got to be a bit careful about that, because as a director, do you want your home address in the public domain? But if you've already got it in the public domain, happy days. Or you've got to have your home address listed on the business rates bill. which is probably very unlikely to be the case. So if one of those applies, then you can get a grant to install a charger at your home.
I wonder if this works for, given the fact that you put rates through like service accommodation, whether you could put an electric car charger at your service accommodation property. Do you know what I mean? Because they're registered on business rates often rather than council tax, aren't they?
Well, that's going to be an interesting one, because I think that with service accommodation, they're actually not normally registered on business rates now because of the change that they've got to be, is it 180 days?
They've got to be, the changes come in yet, but
they've got to be rented for to qualify for business rates, otherwise they sit on council tax, because I've got a service accommodation business and they pay council tax on every property.
Okay, great little tip, thanks Claire for that. And as always, if you feel like you might have outgrown your current accountant and you would like to work with Claire and the team at Profit Cash Growth, whiz over to the website profitcashgrowth.com. On there you can book a discovery call, or you could book a free financial health check of your business to get things rattling on. As always, hope you enjoyed the podcast, and all of the episodes are immensely evergreen, so do go back through the back catalogue. There's loads and loads of education to learn about how to improve your cash flow, increase your profits, and grow your business. And as always, rate, review and subscribe, and we will see you again next week.